Okay. Yeah, I guess
All right, just loading up here. Just take a moment to pause it on the other one. Yeah. Okay, so are we good, Paul? Yeah?
Yeah, all
Good
good.
to go? Okay,
All good.
Excellent. Hello, everybody. Thank you so much for tuning in for this month's session of Succession Matters. Today, we are going to be touching on the topic of valuation. If you aren't familiar with our new project of Succession Matters, we are trying to bring topics of various succession areas to light by discussing them with our beautiful circle of professionals that we have at our fingertips, which is really lovely. And Paul is one of those individuals that we go to quite often for the topic of valuation. If you're not familiar with succession matching itself, we are a two-sided marketplace that focuses on matching buyers and sellers of businesses. And oftentimes we work with individual business owners to help them develop and form a succession plan so that they can be successful in their sale. So I'm going to turn it over to Paul just to introduce himself and let us know a little bit about what you do.
Okay, thanks, Chelsea. So my name, to begin with, my name is Paul Maarschalk. I am a chartered business valuator, and I'm also a chartered professional accountant. I got into accounting long before I got into business valuations. I'm originally from Zimbabwe. I came to Canada in 2001. Became a Canadian chartered professional accountant, and in the mid zeros or noughts, I'm not sure how you say it, but around about 2005, 2006, I did a program towards the chartered business valuator designation. So I've been doing that now for about 15 years, and I've done a few other bits and pieces along the way, but for the last 8 years or so, I have specialized 100% in valuing businesses. And I guess that's what we're here to talk about today. So Chelsea, if you'd like to take it away and ask me whatever questions you have.
Yeah, all the questions for sure.
Okay.
It's interesting that I'm sure it's common. Most valuators start on the track of accounting, right? Like you kind of have to be an accountant first. Yeah,
it's not essential, but it's certainly helpful. And
yeah,
I would say probably about 60 or 70% of CBVs, that's the designation we use, are also CPAs.
Right.
Which is the accounting designation. Yeah.
Right. In our formal succession planning program, this is something we sort of launched over COVID, where we work one-on-one with business owners to form those succession plans. One of the things we do recommend a lot of business owners do is build or hire a third-party valuator, do a valuation of some sort. And we're usually met with the question of what is a valuation? And I'm sure you understand that question all too well. So let's start with the very basics here. Paul, can you explain to me, as if I didn't know, what is a valuation and why a business owner might feel the need to get one done?
Yeah. Okay. Well, that's actually a really good question, because there is a misunderstanding sometimes about the very word valuation. And very often people think of it as evaluation. Now, just to distinguish between those two in my mind, an evaluation is really when you get somebody to come into your business, they look under all the hidden places, they find areas where you can improve the business, and give you a kind of a scorecard on how you're doing and how you could improve. What I do is some of that I cover by the way, but the purpose of what I do really is to put a value on your business. So I look at the business in a lot of different ways, but ultimately I'm going to be saying to you, your business is worth this number of dollars, or within a range of this number of dollars. Now, where a business is incorporated, what that might then entail is me saying, and this is after a fair amount of work, and I've done what you engaged me to do. I'll say the business that your operating business is worth X amount. The shares of your company are worth Y amount. And it's common for business owners to conflate those two ideas, where they think that the company is worth the same as the business within the company. Very often that is the case, but not necessarily. Sometimes there are a lot of things in the company that are not necessarily essential for the business. And therefore, the value of the shares of the company may well be somewhat different from the value of the operating business. And that's important when you are selling the business, because you need to decide fairly early on in the process whether you're planning on selling the operating business or the shares of the company.
Right, of course. I didn't realize there was such a distinction between if you're incorporated or if you're not, in terms of how that, but it totally makes sense. Absolutely.
Mm-hmm.
So aside from, the difference between an incorporated business and not, like what factors are you looking at? And I'm sure it varies across the board depending on the sort of business that you're working with. But what are the sort of primary factors, the key factors that you look towards to help determine that valuation?
Okay, I think there's really, I guess there's two key issues, and these are fairly involved, each one of them. But if we were to summarize it down to two key issues, the first one is, what are the prospects for this business? In other words, how much revenue can it generate? What kind of profitability are we seeing? And that is always a forward-looking thing, because if you think about it, if you want to buy a business, you may be interested in what the business has done in the past, but what you're really interested in is what that business can do in the future. So the past might help to inform your view of the future, but you're really interested in the prospects. So that's the one issue. The other key issue is, what are the risks in this business? And if we can summarize the risk, it is, what is the risk or the possibility that the prospects that you are saying are in this business will actually be materialized? So, if you've got a very high risk business, you might say, well, this has the possibility of generating, let's say, $1 million a year in revenue. But if it's a high risk business, that could be challenged by a number of different things. And maybe the revenue might be $1.5 million, it may be $1 million, maybe well under $1 million, but those kind of risks affect the likelihood of the continuation of that revenue. So we have to be aware of the risks that are in the business.
Right. Can you give a few examples of a high risk business or risks within the business?
Yeah. It might be easier to illustrate it first with a low risk business.
Okay.
So a low risk business would be, now I don't expect many people would own a business like this, but a public utility, for example. So an electricity supply business usually sign up 20, 30, 50-year contracts for supplying electricity to a certain place. So you know that in the future, that revenue is going to be there. And I think intuitively, we know which businesses have the greatest longevity. Which businesses are going to be around for a long, long time. Some of those essential services, a convenience store in a small town where there isn't any other convenience store or grocery store for miles and miles and miles. That convenience store will be around for a long time. Now, on the other end of the spectrum, a high risk business would be one where it's a sort of classic here today, gone tomorrow. And let's use, for example, a startup internet style company, if you like, a .com or a software based company. It's got no real track record. It's highly dependent on the people who've developed it. You just don't really know whether it will still be in business in a year's time. Some restaurants are in that category. Restaurants typically have a high turnover, and so in those cases, we would say this is a high risk business. And the implication of that is that the lower the risk, the greater the certainty is that it will be around, and therefore the higher the value, all other things being equal. The high risk businesses, we're not really sure whether it'll still be around. There's a high risk that a person buying the business will lose their money, and therefore that business, all other things being equal, will be worth less than a business that is a low risk business.
Right, that makes complete sense. And I think it's really interesting that risk plays into valuation, because you're getting a number at the end that's going to be more accurate to like the long-term value of the business, not just like what it's worth in the moment, right?
Exactly.
Sort of.
Yeah. No, that's, and what the business is worth in the moment is largely connected to what kind of inventory does it have, what kind of equipment is there in the business, those kind of tangible things. Where the risk comes into play is in the value of the goodwill in the business. And that's really where a business valuator should be able to help most, is in establishing the value of the goodwill in the business. And the goodwill is really dependent on, how long the business is likely to continue. How long will it continue to generate revenue?
And goodwill is something we hear from business owners all the time. And it seems to be that many business owners put quite a lot of weight into what they feel their goodwill is. And then maybe a discrepancy with what it actually is worth. Can you speak to that a little bit? Like, how do you measure goodwill? It feels perhaps more abstract than other elements, like what their assets are worth, or what their revenue has been.
Yeah. No,
how do you measure goodwill?
Well, that really is at the heart of
that's the big question.
That is at the heart of business valuations, because, as you say, most people working on their own can figure out what the value of their inventory is. Goodwill is that kind of intangible thing that is a measure of how much value is in the business over and above the value of the inventory or the capital assets, the machinery, and so on. The goodwill is really where the risks in the business come into focus. Because if you think about buying a business, and let's say the asking price for the business is, let's just say $500,000. And let's say that has been analyzed as comprised of $100,000 of inventory, $200,000 of assets, machinery or equipment. And I guess that would then leave us with $200,000 of goodwill. Somebody buying that business will know that even if the business goes bankrupt after a year, they can more than likely sell the inventory, sell the equipment, and so on, and maybe take a bit of a hit on the value of those, but by and large, they're going to get their value back for that part of the investment. But the goodwill is the piece that is most at risk. Now, you mentioned that a lot of business owners tend to overvalue the goodwill. That's not always the case, but it is a common feature. And I think that the key reason that business owners tend to overvalue the goodwill is that business owners tend to underestimate the level of risk in the business. And there's a very simple reason for that. Most business owners, once they have owned a business for 5 years or longer, they know what the risks are in the business. They know they have to retain their customers. They know they have to keep on sides with their suppliers. They know how to deal with the employees and so on. All those things that are those kind of intangible aspects of running a business. Somebody who's owned the business for a while knows how to manage all of that. They know how to manage the ups and downs of the economy and so on. So they see it as being, oh, this is we can run this business fairly easily. It's no problem. We just get up every morning and we go to work and we manage the business.
Right.
Now, that's because they know how to manage those risks. Somebody looking at it from the outside will be saying, whoa, you've got all these employees and I don't know how I'm going to deal with them. You've got supply lines, you've got this, that, and the other. And so somebody looking at a business from the outside will generally see risks that are less manageable than the business owner who has been there for a number of years and has learned how to value those, how to manage those risks. So when your perception is that the risks are higher, you're going to lower the value. When you think that the risks are low, you're going to inflate the value. And I think that's one of the key reasons why business owners tend to value their businesses more than a potential buyer. There's an element of ego as well. If you built a business,
There's an emotional aspect.
Yeah, that's exactly right.
There's an emotional aspect. Yeah.
So this is your baby. You've developed this business over 30 years, and so you see it as being something that is highly valuable. Somebody looking at it from the outside is not necessarily going to see it in the same light.
Right.
So that's where the challenge is in bridging the gap between the owner, the seller, and the buyer. And I'm sure you might want to ask me a few more questions on that line because I have some thoughts on that.
I bet. Well, I don't want to take away from your thoughts. So, definitely circle back to anything. But now I'm thinking, okay, you have what you think it's worth. You're understanding the valuation of the business itself plus the goodwill. How do you then land on an asking price? Like where is that differential coming into play? Like if you think it's worth something, right? Because of that emotional aspect, you've had a valuation done. What if those two numbers are vastly different? How do you land on an asking price that is realistic? Especially because I find a lot of our sellers as well, like they're moving to the next stage of their life, which could be retirement. So there's an expectation that they need money to, make it through that phase too, right? So any wisdom on that, Paul?
Well, you can't really say that I need X dollars to get through retirement, and therefore that's what my business is worth. I think everybody knows that. But there is a certain amount of wishful thinking that you figure you need this amount of money to get through retirement, and that's what you're going to ask for the business. I see settling on an asking price it's a balancing act between being reasonably realistic, knowing or having a reasonable idea as to what the business is really worth. And keep in mind there that a business valuator generally will be working towards the fair market value. Now, fair market value is a notional concept, and the best way to understand fair market value is to see it as being value in a fair market. We know that markets are not fair, but in order to get to fair market value, we make an assumption that the market is fair. And by being fair, it means that everybody knows the same thing. There's nothing that is hidden. There's a whole definition of fair market value, which escapes me offhand, but it means that nobody's really compelled to buy or sell. And that features into the asking price. If you are compelled to sell because you need to move away or whatever, you might lower your asking price in order to get the sale. But when we work towards fair market value, we assume that everybody's equally knowledgeable. Nobody is pressured to buy or sell. You're going to pay, or the buyer will pay you outright. There's no staged payments, those type of things. So it's a very open market. There's no restriction on the number of people who might be able to buy or sell. So it's a very notional concept. However, it's a very good starting point, because a business valuator will come in. They should be totally objective about it, and they should give you good advice and say, this is what I believe is the fair market value of your business, and this is why. And the evaluator, if they've done their job well, they will be able to explain the component parts of how that value is derived. Now, that's what the evaluator concludes as being the fair market value of the business. The asking price is different to that. And this is where the negotiating style of the business owner really comes into play. So let's say that a business valuator tells the owner that their business is worth $500,000. And the business owner is a very cautious kind of negotiator. Okay. That business owner might then say, okay, I'm going to list this business for $550,000 because, you want to get a bit of wiggle room. Right. But I'm going to stand firm on that 500,000. I'm not going to sell for any less than that. Even if it takes me 2 years to sell the business, I'm going to stand firm on that. So that's one negotiating style.
The other, it's almost like an opposite, like to a BATNA, right? Like you're familiar with the best alternative to negotiated agreement. If you're not, no worries.
No,
not quite. So yeah,
I haven't heard that term.
When we talk to business owners, we often say, like, okay, if this is your asking price, right? How low are you willing to go? Like, what's the best case scenario? What's the worst case scenario?
Yeah.
But I really love the way you just explained that, because it's almost the opposite. Like, like you start with the lowest you're willing to go and sort of like determine your asking price by working up from there a little bit. Maybe I'm misunderstanding.
Well, no, I think you're on the right lines. But what I'm thinking is the negotiating style of the business owner, the seller. They might be the kind of person who stands on a street corner selling leather purses. And they say, I want $100 for this, and somebody else comes along and says, no, I don't think it's worth $100. I'll give you 20. And eventually you settle on 30. Now that business owner was shooting for the moon. In other words, you have a business that the valuator said it's worth 500, but you know that you need $1 million to retire. So you take a flyer and you say, okay, well, let's see. Maybe somebody will buy it for $1 million. So you kind of shoot very high, but then you come down, you're prepared to come down a lot. So that's the negotiating style of the person. Not everybody is comfortable with that. I certainly wouldn't be comfortable with shooting for a price that is way above the fair market value. But I think it is also true to say that a lot of small businesses do sell for higher than their fair market value. And there's various reasons for that. And sometimes they sell for a lot less. But if you have, for example, in a small city, and you have a couple moves to town, and one of the parties in the couple has a job to come to, and the other one, where it's the husband or the wife, other party in the couple doesn't have a job to go to, but they need something to do. They might end up buying a business, and because they are desperate for something to do, they might end up buying the business for more than it's intrinsically worth. That's a fairly simple example, but it does happen that, often small businesses will sell for more than what they're really worth. Now, there's a lot of reasons for that as well. It's not just as trite as saying, I need a job.
Right.
Therefore, I'm going to pay more. It could be that the new owner sees something in the business that they can do with it. Maybe they own another business in another city, and they're going to get economies of scale. And you would see this in the fast food business, where let's say somebody they own a franchise for an existing fast food outlet. I won't use names because people think I'm advertising. But and then they have the opportunity to buy another franchise of that same brand. Now, there are synergies involved in that. And this is where very often you'll find that a buyer is comfortable paying more than the fair market value of that standalone business, because they can see synergies within a business that they already own. And so they can cut down on administrative costs. They can cut down on ordering. They can maybe do some bulk buying and so on. So in that case, it makes a lot of sense for the buyer to pay a bit more for that business, more than the fair market value, because there may be 5 people wanting to buy that business. So if you can see synergies with another business that you already own, you can create an advantage, or you have an advantage that allows you to pay more, and therefore you secure the deal. Whereas somebody coming in from outside who's only going to buy that one outlet, they don't have those synergies, and they really shouldn't then pay more than that fair market value.
Right. So really the motive of the buyer is a huge factor here.
It's very big. And this plays into, you remember I was talking about the definition of fair market value. It includes things like motivations and so on. And once you get either the buyer or the seller is motivated in a particular direction, you're going to end up with a price that is different to fair market value, simply because price, and this is something really, in simple terms, people need to know, price is not the same as fair market value, because fair market value is this theoretical, notional term, assumes a lot of wonderful things about the market being fair. And no market is ever perfectly fair. And so it depends on how you play into the unfairness of the market. And if you're a savvy seller or a savvy buyer, you can use those little elements of unfairness to influence the final price that is settled.
Right. Well, that makes a lot of sense.
Now, just while I think of it, the other
Yes.
thing that I did touch on earlier that I wanted to come back to is in relation to goodwill and the transitioning goodwill is one of the hardest aspects of selling a business.
Right.
And what I mean by that is it's easy to transition the equipment and the inventory and the motor vehicles and so on. It's just, give somebody the keys or, whatever, and they now own those tangible assets. Goodwill is comprised of so many intangible aspects that it is really, really tough to successfully transition that goodwill from a previous owner to a new owner. And the key thing about goodwill, a simple way of looking at it is most of it's in your head of the seller. And so it's things like knowing who your customers are, knowing your suppliers, all of those intangible aspects about running a business. You need a good transition plan. And I think it's fairly common knowledge that when you sell a business, you're going to be expected to stay on for a while to help the new owner get into the business.
Right, a mentorship period, yeah.
Yeah, and the reason for that really is because of this transition of goodwill. And I think if people can see it that way and really understand why you want that other person to stay on, you almost need to take as much value out of the previous owner as you possibly can. And so you kind of use that previous owner to educate you on how to run this business successfully and, essentially replace that previous owner with the new owner, put them in the same position as they were. Now, that old owner has accumulated maybe 30 years of intangible stuff. So what I often say to people who are selling their business is that if you want to achieve the price that you want, or at least get a better price than you might otherwise get, then be prepared to stay on for maybe a longer period than might otherwise be the case. Because by staying on for a longer period, you have a much greater chance of transitioning that goodwill completely. If you stay on for 2 weeks, the new owner is likely to, be, all at sea when they first arrive. That 2-week period is probably not long enough to transition the goodwill. If you agree to stay on for, let's say, 3 months full-time, 6 months part-time, be available for another 6 months, that sort of thing. And it really depends on the business itself, but be available. And I believe that by being willing to do that and putting that into the purchase and sale agreement, so it's a contractual thing, that way I think the seller more than likely can achieve a higher selling price than they might otherwise do. And to get back to all the risks that I was talking about beforehand, what you're really doing by staying on in the business is you are lowering the risks for the new owner. And by lowering the risks, you automatically increase the value.
Right.
Does that make sense?
It totally makes sense. I'm also, and correct me if I'm wrong, I don't know if this is worth mentioning, but goodwill is often not bankable, right? If the buyer is looking, for financing, that'll work against them as well, right? So Like, can you mitigate that by offering the mentorship period, or do banks just not recognize it at all? Or do you need anything on that side?
It really depends on the banks. And
Of course.
the traditional Main Street banks, they generally don't like lending on the back of Goodwill. However, some banks, and in this case, I will mention a name because they are unique. Business Development Bank, government owned. They're there in business in order to promote entrepreneurship, and they will do what is known as cash flow lending. And other banks will do it as well, but it's a bigger thing with the BDC. It can be expensive to borrow money against. It's really borrowing money against Goodwill, but the way it is termed is it's cash flow lending. So the bank will look at the projected cash flows of the business in question, and if those cash flows look like they are steady, reliable, and of a decent magnitude, then they might consider lending on the back of that. It's essentially they're lending in order to fund the acquisition of Goodwill. But you're right, it is a challenge, and quite often you can overcome that by getting the payments for the business. If you stage those payments, so you put down, usually a fairly substantial amount to begin with, maybe 75%, and then you agree that the next 25% is dependent on certain things. And this is where, as a business seller, if you stay on and you help manage that business going forward, you can make sure that the business achieves the level of cash flows that you said it was going to, and those cash flows in themselves will help to pay off the seller for what they, and that's referred to sometimes as a vendor take back loan, where the seller has the hopefully never to be exercised, but they do have the option of taking back the business if they're not paid in full.
Right.
You really do need to have a good, solid purchase and sale agreement that covers these kinds of issues, and it needs to cover the issue of what that seller will do once they've sold the business. So non-compete agreements, if you're prepared to sign a non-compete agreement, that should enhance the value of your business as well.
Of course, yeah. Good paperwork makes for good friends, right?
Exactly.
That's what we always say.
Yeah.
So I think we've definitely touched on the topic of valuation and Goodwill and everything in between. Another thing that I've sort of heard from our team that works directly with business sellers is individuals, when we encourage the valuation, it's not necessarily necessary for everybody, right? But some will say, I've been with my accountant for 20, 30, 40 plus years or whatnot. Can't they just do that? And I know, like, my partner actually is a CPA, and he won't touch valuation for his clients because he says, I'm not comfortable with that. But they'll advise for sure, right? But to actually do a proper valuation is a different skill set alone. So what would your advice be for a business owner who has had an accountant that, they've been working with since almost the conception of the business, knows the business very well? Like, at what point is it more beneficial to hire a third party evaluator and, like, go that route than just use an accountant that, you've been with for years and years and years?
I think your accountant is probably the best person to start with. Most of the work that I get is actually referrals from accountants, regular corporate accountants. And I would say that, accountants vary. Some like to be able to do everything, and some of them will have done some training in business valuations. And depending on the business itself, it may be relatively easy to value the business. And typically a kind of cookie cutter type of business is going to be easier to value than something that is a little bit more different, unique. But a lot of accountants as well will recognize their own limitations and will quite often know of one or more qualified valuators that they can refer their client to. And so it partly depends on your accountant, but I would suggest that the accountant is the best place to start. If the accountant kind of says, well, maybe I could do it, maybe not, then you probably, you need to develop whether you are comfortable with what the accountant is telling you. And if you feel that the accountant can do a decent job, then, by all means use the accountant. If you feel that they're on shaky ground, then it's probably time to look elsewhere. The thing to keep in mind as well is that when you get a valuator to calculate fair market value, that really is a guide. And, we were talking about the difference between asking price and fair market value. There's no requirement when you're buying or selling a business that you have to settle at fair market value. So the final determinant of what you sell it for is based on negotiation, and that fair market value calculation is a kind of guide, but it's not the be all and end all. I do a lot of other valuations where the fair market value report is a critical piece of information that might be used in a court. There's a matrimonial issue or shareholder dispute and so on.
Okay.
But when it's for transactional purposes, it's not critical to get it absolutely pinpoint exact. So it really depends on the business itself. It depends on the accountant. And it also depends on how much you're prepared to pay for a full-blown valuation. A full-blown valuation can be quite an expensive operation. Many thousands of dollars, $6, $7, $8, $9, $10, depending on the business. It could even be much higher than that. And so you need to put that in perspective and see, well, if you're going to sell the business for, maybe it's a small business, you might get 50 grand. There's no point in spending $5,000 on getting a valuation, because ultimately you're going to negotiate the price anyway. But if you're not sure, and you really, and let's say there's a lot of unique aspects to the business where you need somebody with that, training and experience to come in and, exercise their mind on what that business really is worth. And they'll often see things, maybe even see opportunities that, you might not have seen, which creates new value. Where I find as well that I see a difference between accountants and qualified business valuators is that accountants can quite often tell you the value of the business itself, that operating business. When it comes to calculating the value of the shares and all the other little bits and pieces that go into the value of the shares, that's where I find that some accountants will tell me that they don't really feel that they can address those kind of issues. So a lot of it is dependent on the complexity in the business. And generally speaking, the more complex the business, the more likely it is that you need a specialist who is trained and experienced in this particular thing.
Of course, address those nuances, right?
Yeah. Yeah.
And so do you think, and this will be my last question because I'm aware of the time here. I don't want to take up your entire day, Paul. But do you think that having a third party valuation, especially if you're a bigger business, like let's say, I mean, we can define bigger businesses, big businesses, but like between the 500,000 and a million or 2 million mark, having like the stamp of like, yeah, we had this valuated, could get a better rate for the business, or a better, like, you can up your asking price because you had that valuation done, and you have a more accurate stamp of approval for your fair market value.
Yeah, absolutely. Once you get into that larger size, it becomes financially worthwhile. And I think it depends on whether you want to share the valuation report with a potential buyer. And obviously what that then does, if you share the report, you're kind of showing your hand to the buyer.
Totally. It's a vulnerable space.
But what I see, and I see this quite often where business owners are selling the business to an employee. Quite often the employee kind of knows what's going on in the business. And in those cases, the business owner is much more open to sharing the report. And, the buyer and the seller are both reasonably knowledgeable about most of the aspects of the business. It really depends on how much information has been shared with employees prior to that. But that's where I'll see that often a business owner will share the report with the prospective buyer. But I think you're absolutely right that if there has been a formal valuation done, even if you don't disclose all the details in the report, it does give a lot more credibility to the asking price. And a buyer would, I think, certainly be much more comfortable buying a business at a certain price, knowing that an objective third party has looked at it. Now, if you get your cousin who happens to be a business valuator, the buyer might question whether that person has been objective. But theoretically, the valuator should be objective, and give good advice to the seller.
Naturally. Yeah, perfect. Well, thank you so much, Paul. That was all very enlightening. I feel like every time we talk, I learn something new, especially in the world of valuation, which is definitely way over my head 99% of the time. So,
sure.
For those of you who are listening, Paul is one of our preferred partners on Succession Matching. So if you're a member, you can find his information there. I'll also leave his information sort of in the show notes for this as well, if that's okay with you, Paul.
Oh yeah, absolutely.
Yeah. So if you want to reach out to him for a valuation, you're definitely welcome to do that. And other than that, we'll
maybe I can just say one thing. I did make reference to the fact that a valuation can cost multiple thousands of dollars. That would be if you are getting a full-blown valuation report. Very often it's not worth your while getting such a big report. But it might still be worthwhile going and sitting with a valuator and just discussing it. And I've spoken to other valuators who will do this kind of thing where you're not necessarily issuing an opinion and you're not necessarily issuing a full report, but you can still offer some professional guidance on what your business might be worth. And that typically would be a much less expensive exercise. I think you just need to have an open and frank conversation with the valuator and see whether they're prepared to offer that kind of service. I know I've often done that where it's a really small business and the business owner really doesn't know doesn't have any idea what they could ask for it, and yet they just need a little bit of guidance. And I'm happy enough to do that as a service as well.
That's amazing, and really good to know for some of our small business owners out there, like that there's some accessible resources to them that might not be out of reach because of financials. Yeah, really important. Cool. Thanks for clarifying that, Paul.
Okay.
So I'll add your details in the show notes. Anybody can reach out to Paul at any point and get his wonderful advice and work with him as a evaluator if you so choose. But other than that, thank you so much for taking the time. I really appreciate it. Thank you, everybody who tuned in today. Yeah, we'll be in touch and talk soon. Take care.
Okay. Thanks, Chelsea. Thanks.
Okay. Thank you.
Bye-bye. Bye.
Bye.